What is the objective of integrity adab and the conceptual framework? Let's see. The conceptual framework of accounting ensures that financial report provide the relevant and faithful information and also helping the user to make a decision and assess the management and stewardship. When other Islamic ethics integrate into this framework, the objectives become more holistic. Financial reporting must not only comply with IFRS standard, but also uphold ethical values such as honesty, transparency, fairness, and social responsibility. This integration ensures that accounting information is just not only technical, accurate, and consistent, but also morally responsible and social beneficial. In essence, the framework shows how the information should be communicated, what the ethics show why, and ethically how it should be done, so that integrity is maintained, fraud can be avoided, and all the parties will get the benefit. Integrated adab in Islamic ethics with the conceptual framework ensure that accounting is not only accurate but also ethical and trustworthy. Here are 4 principles of incorporating adab into Islamic ethics. The first one is siddiq, means that financial information must be truthful and not manipulated. For the second one is adil, means justice, require the accountant to be fair, careful, impartial when they dealing with the stakeholder. For the third one is amanah, means trust, remind to the accountant that they hold the public trust and must act responsibly. For the last one is insan, means excellent, encourage high quality, clear and timely reporting. Together, this value make accounting technically correct and morally responsible.
Next, me and Alisha are going to talk about what makes financial information useful. The conceptual framework is basically the guide for how financial statements are created and understood. It explains what qualities financial information needs so that people like investors and lenders can make good decisions. There are 2 main qualities, which is relevance and faithful representation. I will explain it to you briefly about relevance. Relevance means the information actually matters and can influence decisions, while the faithful representation means the information is truthful and reflects what's really happening in the business. There are also 4 supporting qualities. First, comparability, verifiability, timeliness, and understandability. This makes the information clearer, easy to check, and easier to use. So, overall, these characteristics work together to make financial information reliable, clear, and helpful for decision making. Next point is fundamental of qualitative characteristic. Let me explain to you what is fundamental of qualitative characteristics. Financial information is considered relevant when it helps users make better decisions. It matters only if it can influence what someone decides to do. It does this through 2 types of value. First, predictive value. The information helps users predict future results. It doesn't have to be a forecast itself. Users can use the numbers to make their own predictions. For example, this year's sales can help estimate next year's performance. Second, confirmatory value. The information helps users check past predictions. It shows whether earlier expectations were accurate or not to be updated. For example, comparing actual revenue to last year's forecast tells you if your prediction method was good. So here's my opinion. Both values often work together. Information that helps predict can also help confirm earlier predictions. Relevance also depends on materiality, meaning the information must be important enough to affect decisions. If it wouldn't change anything, it's not considered relevant. When we talk about economic phenomena, we are basically talking about everything related to a company's finances, its assets, its debts, and the effects of its transaction. A financial report takes all of this and shows it in words and numbers. For the information to be faithfully represented, it needs to be first, complete. All the important details are included so users can fully understand what is going on. Second, neutral. The information isn't biased. Nothing is made to look better or worse than it really is. Third, free from error. There shouldn't be any mistakes that would mislead users. This doesn't mean it has to be perfectly accurate, especially when estimates are involved. But the methods used must be sound and clearly explained. In reality, perfect accuracy is almost impossible. But the goal is to get as close as possible by maximizing these three qualities.
Next, I'm going to explain enhancing qualitative characteristic. This characteristic features improve usefulness of financial information. There are 4 characteristics. First, comparability. When we talk about comparability, we're basically talking about how easy it is to compare one company performance to another company performance, or even the same company across different years. If the information prepared in a similar way, we can see who is doing better, who is improving, and who might be sleeping. This actually really helps with decision making. For example, you are the investor, you are trying to buy, hold, or sell an investment. Having a comparable information makes the decision much more confident because you are not guessing, you are looking at the data that actually makes sense side by side. And in the end, information is just so much more useful when it's consistent over time. When things are reported in the same way every period, it's easier to us to spot trends, understand what's really happening, and make smarter decisions. Second is verifiability. The main idea is that the information we see should truly reflect what actually happened in the real world. In other words, the numbers and report shouldn't just look right. They should generally represent the actual economic events of the company. Another important part is that the information isn't based on personal opinion or guesswork. It's supported by the evidence that the others can confirm, and because of that, the users end up having more confidence in the information. When people know that the data has been checked, supported, and verified by others, they feel more assured that the information are reliable. Third one is timeliness. When we look at timeliness, we think that the information is much more useful if it's provided quickly. If users get the information too late, it loses its value because the situation may have already changed. So, newer information usually leads to better decision. For example, managers or investors rely on up-to-date numbers to decide what action to take right now, not based on what happened a long time ago. But at the same time, not all the data becomes irrelevant. Some long-term data is still important because it helps us see patterns and trends over time. So, while fresh information is a key for immediate decision, historical information still plays a big role for understanding the bigger picture. Lastly, understandability. It simply means that the information should be presented in clear way so that users can easily follow what is being reported. The aim is to make the information straightforward without losing its accuracy. Even when we try to make the writing simple, some technical details still need to be included. If we let them out, the report might be incomplete or give them the wrong idea. So, certain complex parts are necessary to show the full picture. This characteristic also assumes that users have a basic level of knowledge. If they find something unclear, they can look it up for more information. In the end, making something easy to understand is about finding the right balance between being simple and being complete.
Lastly, I will explain about components of financial statement. Inside component of financial statement, there is 4 elements, which is recognition, presentation, measurement, and disclosure. Firstly, recognition. Recognition is a process of capturing for inclusion in the statement of financial statement, which consists of an asset, a liability, equity, income, and expenses, that is designed to make financial statement comparable and understandable. For example, a company recognizes an asset such as equipment when it's purchased and gains control in the company. Lastly, I will explain about components of financial statement. Inside component of financial statement, there is 4 elements, which is recognition, presentation, measurement, and disclosure. Firstly, recognition. Recognition is a process of capturing for inclusion in the statement of financial statement, which consists of an asset, a liability, equity, income, and expenses. Next, I will talk about measurement in financial statement. Measurement refers to the process of determining the monetary amount at which the element of financial statement, such as asset, liability, equity, income, and expenses, are recognized and reported. These amounts are based on different measurement bases. The main measurement bases include historical cost, fair value, and fulfillment value. First, historical cost is the original price paid when an asset is acquired or when a liability is incurred. It is easy to verify and is commonly used because it reflects the actual transaction amount. Second, fair value represents the price that will be received to sell an asset in an orderly transaction at the measurement date. It reflects current market condition. Third, fulfillment value is the present value of the estimated future cash flow that an entity expects to receive from using an asset from its eventual disposal. Next, I will talk about measurement in financial statement. Lastly, I will explain the concept of presentation and disclosure in financial statements and how it relates to effective communication. Effective communication in financial reporting helps make the information more relevant and ensures a faithful representation of a company's financial position. To achieve effective communication, financial statement must provide relevant information. This includes information that represents the entity's asset, liabilities, equity, income, and expenses accurately and complete. Next, the information presented must be comparable. Comparability is important both from one period to another and within the same reporting period. When information is consistent and comparable, users can identify trends, analyze performance, and make better decisions.
These reports highlight the evolving nature of ethical challenges and the increasing complexity of ethical dilemmas in accountancy. Based on over 1,100 responses from 135 countries, the findings reveal that 55% of accountants have witnessed unethical behavior in their career, and almost 1 in 4, 24%, have been put under pressure to behave unethically in the last 3 years.
Last but not least, the conclusion. Thus, integrating Adab with the accounting conceptual framework builds both competence and strong moral character. Therefore, by grounding accountants in values like truthfulness, justice, trust, and excellence, helps prevent unethical behavior. This combination shapes professionals who are ethical, trustworthy, and responsible in carrying out their duties, also ultimately strengthening the integrity of the accounting profession.
That's all from us.
Thank you.